Hello and welcome back to Markets in 2 Minutes. This is Darrell with the Wealthspire Investment Team, and our focus today is going to be the Federal Reserve. So Kevin Warsh has now settled into his new role as Fed Chair, with the first meeting of his tenure now in the books. And one of the main differences between Warsh and Powell is that Warsh is less convinced that the Fed needs to be overly communicative. In fact, he's been on the record in the past saying that there are downsides to the Fed providing too much insights into its plans because it runs the risk of backing them into a corner when it comes to policy decisions. And so the market is going to need to get used to operating with a little bit less transparency from the Fed, but that doesn't mean that we can't track the data ourselves and allow that to shape our expectations going forward. Because after all, the Fed has access to the same data that we do. And the first piece of data we want to share here is a historical comparison between the path of inflation during the 1970s, the so-called stagflation era, and then today. And you can see that there is a little bit of a rhyming to the pattern here. And the key historical consideration is that inflation tends to come in waves. Warsh and the other members of the Fed know this, they're students of history, and so that needs to be kept in mind when we think about what the next policy move may be. Right? The Fed does not want a repeat of the 70s, where inflation surged back and even briefly surpassed its previous peak. Now, that does seem less likely this time around for a variety of reasons, but it nevertheless is important context. And the second piece of data is a much more recent phenomenon, and it has to do with how closely short-term interest rates have tracked and now decoupled from oil prices. So what this is telling us is that initially at the onset of the war in Iran, short-term rates were reflecting a jump in inflation expectations that were primarily driven by the surge in oil prices. But now that oil prices have moved lower, those rates haven't followed suit. So that tells us that the market is now cognizant of other, more structural drivers of inflation. And that's important for the Fed because those expectations take hold. It's going to make it harder to move forward with a rate cut later this year. And so the next movement in rates is a bit uncertain at the moment, but it is increasingly looking like the Fed funds rate may remain relatively stable for the time being. We'll see you in a few weeks for another glimpse into what we're seeing in the markets. Enjoy your summer.